yeah, it's Sunday, March 30th, a little bit before 5 p.m. Central Time, the best time. You know what that means, everybody. It's time for First Call. My name is Victor Jones, but you're not here for me. You're here for the one, the only, the founder, and the creator, Mr. Thomas Osnoff. Tom, how you doing, my friend?
I'm good. You know what? There's not a lot of Sunday nights when I'm kind of a little bit, excited about what could happen tonight. Yeah. I mean, I don't know if you traded the close, but the close was pretty ugly on Friday, and they closed them like the S&P's about 15 handles underwater. I don't think I've seen that in, I don't know, maybe it's been a year or so. So that means the S&P's sold off after the cash markets closed. That means the market will open lower tomorrow no matter what, but the S&P's might not. And they're about $15 out of whack. And if they open lower tonight, it looks like they're going to be right now. They're targeting maybe $8 to $10 lower. Yeah. That will be very interesting because usually markets make a very short-term bottom and stuff when they have an underwater close. That means like everybody panicked after the close.
So signs of optimism from the contrarian, Mr. Thomas Osnoff, after a week where the NASDAQ. Go ahead.
Yeah, I don't know that that's optimism. I think it just means that I think that they will go down tomorrow, but from higher prices.
Yeah.
I don't think they're going to be. It's very rare that they'll close underwater, open down, and just go straight down. Usually they'll go from a little bit higher prices.
Let me ask you, NASDAQ down nearly 2.5%. It was the underperformer for the week. I think, honestly, that's probably not doing the index justice, because I think on Tuesday we were up 2.5%, almost 3% at one point intraday. So we had nearly around a 5% swing intra week. The Russell was down 1.5%, the S&P down 1.6%, something like that, and the Dow Jones, your grandfather's favorite index, I'm obligated to mention, was also down 1%. That brings the Russell back into near correction territory around 9-10%. NASDAQ down 8% for the year. S&P down around 5%, and the Dow down around 2%. And there weren't many places to hide last week either, Tom. There weren't many places that really looked strong. Staples, energy, maybe, but most sectors were down in the week too.
Yeah. I don't. You get a week
energy
like
being the
week.
worst.
Yeah, you're not going to get any. Energy and tech. Yeah, sure. There's no stone left unturned. I thought on Friday, just before the close, I kind of nibbled on a little bit of Google, just because I thought it got to the point where, it's probably the ugliest of all of them. And I just wanted to buy a few deltas, and I can already regret that buy. I don't even have to see where it's going to open tomorrow. I already regret it. But yeah, this opening tonight is looks like the S&Ps are going to be down, maybe 15 on the opening. It looks like the NASDAQ might be down as much as 60 or 70, maybe even a few more. And so I don't know, Vic. I kind of think there might be a little trade here from the long side. I don't usually say that on a Sunday night, and I'm not short here. I went home totally flat. So I'm actually going to be a little delta long here on this lower opening, but I kind of feel like maybe it's a nibble play.
Look at you. You got a big smile across your face too.
I don't usually nibble.
Going to jump in there.
I don't usually nibble, but I'm thinking that I'm waiting for them to let's see. Oh, we got
Tom's going to be the hero. No. Google was a bit ugly. I mean, I can give you a handful of stocks that were much worse. SMCI got obliterated by 19% last week. I think Broadcom was down 12%. Lulu was down 9%-ish, in that ballpark, I believe. And then there's a whole 7% crew, man, like PayPal, Nike, Nvidia, Micron, Intel. All these things were down around 7%. Pretty brutal week across the board, especially in technology, as I mentioned before. What were you doing on Friday, given that sell-off? Were you just trying to, sort of manage your existing positions? Were you taking any risk on Friday, given the sell-off? Was there anything that looked interesting to you on that close?
I mean, I came in with a little bit of short delta, but Friday was my worst day of the week because you couldn't defend the 10% jump in volatility if you're short premium like I am. Mm-hmm. So, there was no, it was I didn't do well Friday. I mean, I don't think anybody did. Oh, this is a bad opening.
Yeah.
Uh, yeah, I put some bids in way below, but I didn't. Actually, they opened higher than I thought. That's a little
Yeah,
bit
all things
confusing.
considered, not the worst.
It's a little bit confusing because most of this sell-off was already underwater on Friday, so it's a little bit like weird right now. Um, I put an
Who's
80
down
bid
30
in.
handles?
Yeah, they're down 30, but that's just a little weird. But I mean, it's not real 30, but whatever, it's close.
Yeah.
Um, I put a bid in to buy some Nasdaq futures right here, down about at 21-ish. Let's see if we get filled. I put it in a while ago.
Bonds
At
up
least
12 ticks.
at least I thought I did.
Actually, now, yeah,
Maybe I
bonds up
didn't.
12 ticks. Let's see. Not a ton of movement in gold or copper. Natty gas up 3%, something like this. So some decent movement here tonight. Bitcoin down a little bit, which has been heavy. It's been trading heavy most of the weekend. Nasdaq down 0.75%. Again, some of this you have to adjust. The Dow down 0.5%, and the Russell down 0.75% as well. Tom, what do you think about vol here at 21.5? You getting paid for the risk in the market, or given sort of the complexities, the escalating complexities of geopolitics over the last week, the escalating complexities of the global trade dynamics? Do you think you're getting? I know your answer, but I just want to hear you say it for the audience. Do you think you're getting paid adequately for the risk at 21.5?
I mean, the numbers say that you are. Uh, that's all. The numbers say that you are. Um, I, yeah, here's the thing. It's extremely hard to step in to markets like this. It's extremely hard to be a hero, but you do know that those who do stuff in these markets, like the whole reason we had a really good month in March was because we stepped up when everything else was going to hell earlier. And so I think it's kind of the same thing right here. If you step up at these levels, I kind of feel like, I mean, at some point tomorrow you're going to get paid. We'll see. I'm just nibbling right here on a few futures, but nothing crazy. That's for sure.
I guess the mental model that I've had is, I sound like a bit of a broken record, but I think for 4 months we were in 6,000 plus or minus 200. So that was your magnitude of move around a fair value. And I think once we broke that, in my mind anyway, 5,500 is your new value area, plus or minus 300. So you have more volatility than our previous range. And it's sort of funny. We kind of tested the upside of that range at 5,800, which was previous resistance. We failed it. So some part of me thinks 5,500 still probably fair value. You might not get your best price. If we get a flush here, I do think another couple of 100 points to the downside in the S&P could be in the cards. But I do think if that happens, Tom, that's probably decent risk-taking area. I think you're at fair value, and you could get some discounts here over the next couple of days into this week. I think that's the mental model I take into this week.
That's fair. What's funny is that if you think about like different markets and what they've done with respect to extremes, because I don't consider the S&Ps at this point an extreme at all. I don't consider the NASDAQ move an extreme. And so if you consider different markets that have moved to extremes, I would suggest first we bring out the bond market as one example. When it got all the way down to 107, 108 at one time, and people thought it was, oh my God, we're gonna print 100 in here, and it quickly rallied back to 120. But I guess my point is that this markets go to levels that you kind of don't think they're going to get to. Gold to the upside, the bonds to the downside. And there's been some other moves like that where you just kind of just shake your head and you're like, I can't believe that where this market actually got to price wise. And so I don't think the S&Ps or the broad market has surprised us at all. I don't think it's down 10%. Okay, great. I mean, that's a pretty normal, correction. Let's not make more of this than it really is. I mean, it's a correction that's been driven by things that we haven't seen a correction be driven by in a while, but that's just all people putting their stories together, talking their book and whatever. I think that we haven't really seen any real pain inflicted on the S&Ps yet. And so that's the one thing in the back of my head that leads me to think that like I just remember buying bonds at 114 and 110 and 108 and thinking, how could these things go any lower? And they got down to like 106 and change before they turned around and rallied, 15 handles. I can see the S&Ps, flushing out, and I don't think they've done it yet. Here's the challenge. The challenge is that Friday they closed underwater, and usually we don't wash out from an underwater close. Second, tomorrow is the last day of the month, and we rarely wash out at the end of a quarter and the last day of the month. It's rarely a washout. It can be funky, but it's rarely a washout. And so you've got those two factors, and then you have a relatively strong month in April. April's always been, a pretty good month for the market. So because there's a lot of 401k money, there's a lot of buying. I'm just saying, whatever it is. So it would surprise me here, and I think it would surprise everybody else if they just completely washed out. But it's the one thing that I can't rule out because it's the one thing that hasn't happened to this market in since 2020. We had a nice sell-off in 2022, but since 2020 we had a washout, and before that you'd have to go back to 2018. And then, so I'm not so sure that we've seen the worst of it. That's all,
I couldn't agree more. Speaking of bonds, if I told you we were going to get some, rise in volatility, some risk off sort of behavior in the marketplace, and bonds were basically not really going to move, we would be at 117 again. Every time we come in here on Sunday, plus or minus, I'm telling you, bonds are at 117. Yeah. And given the fact that you've got that sort of escalating volatility in equity markets, are you in any way surprised at the relative tranquility of the bond market? And it seems like all that risk off capital, instead of taking a bet on the long end in U.S. Treasuries, given, you're going to hate this, but given our poor fiscal sort of trajectory, it seems like more people are willing to put an incremental dollar towards the gold market as sort of a risk-off asset.
Which is absolutely the dumbest. If anybody is buying gold here because that's your flight to quality, you should have your head examined. That's going to turn out to be probably the most regrettable trade of 2025.
Tell me why you think that. So you think gold is at a massive extreme, and you think there's a huge fat left tail in gold.
Yeah, I think it's at a price extreme right now, which will be very difficult for it to sustain. And it's not like, I don't think gold's going to turn around and go down $200 tomorrow, but I do think gold's in a spot right now where it would be. I absolutely hate the risk reward here. I think you're risking 4 to make 1. And I don't like the risk reward to the upside in gold. And I don't think it's a flight to quality. I also don't think that there's any play. Like for example, you're talking about bonds. Yeah. I don't like bonds. I thought were played last week. They traded down to 115.5. Yeah. They were play there. I mean, we loved them there. But 117.5 right here, I wouldn't touch them. I mean, I wouldn't get short them, but I wouldn't buy them here. I don't even think they're a play. They sucked a lot of premium out of the bonds. They're not interesting here. And I don't really think there is a commodity up here other than gold as an interesting, okay, maybe there's something to do in here, maybe gold, but it's a one-trick pony. In the stock market right now, everybody should be focused on the stock market because it's all that really matters. Every single play is in the stock market. I mean, even digital assets, there's no play there now. They're dead. And so I don't think there's a play in Bitcoin. I don't think there's a play in any of cryptos. I think this right now, your best volatility and your best risk reward for whatever direction you want to play is in the stock market. You're going to get the most bang for your buck. Right now, we got vol's up 80 cents tonight. That's a huge move tonight. So you've got 22 in the VIX futures. You're going to have, the VIX trading, well over 22 tomorrow. You're going to have certain stocks that are going to be have stratospheric volatility, especially these tech stocks. You've got some people that are going to trend traders that are going to think they're all breaking down. You've got contrarians that are going to be trying to buy dips here. You've got massive premium on both sides of the market because when puts are expensive, calls are expensive. So you've got massive premium. You can do anything you want. There's no, we should not spend 1 minute tonight talking about commodities because they don't freaking matter right here. This is a market that is going to be driven by Nvidia, by Google, by Tesla, by Apple, by Amazon, by Coinbase, by Meta. I mean, these are stocks that are going to move around 25 handles a day, some of them 10, 5, 3, whatever it is. They're going to have absolutely massive moves. There is no reason to torture yourself, playing in micro silver or 10-year notes. It's a waste of resources. It's a waste of time. Like, here's the thing. In the business we're in, you should be attracted to the noise. Like, Don't let anybody fool you. We had a question on Confirm and Send this past week. It said, what do you mean by trade what's in front of you? And that means you should trade where the noise is. And the noise is this week. It's going to be in the stock market VIX. There is everything else is secondary.
As a unrelated aside, last week the top performing industry was GDX, and it was the gold miners. So it was
but that's a crazy thing to say because to be fair, that's an untradeable stock. I mean, it's a crappy, crappy wide market son of stock that if you're right, you can't make a dime.
All right, let's do this.
Yeah.
I want to so we keep the show moving. I want to do two things at one time. I want to get Pete Momet in here on First Call, and then I want to go through a series of tech stocks that they seem to be at an area of technical support, and I want to get your opinion on it. If Pete wants to weigh in, we can, and then we'll go into some other topics. You cool with this?
Yeah, sure.
Pete Momet, welcome to First Call.
Gentlemen, thanks so much. Good to see you, Tom. Good to see you, Victor.
How about that Lakers-Bulls game?
Yeah, how about it?
Pete?
Yeah, longest game-winning shot ever. Wasn't that the case, I think?
No, longest game-winning shot for the Bulls ever.
Right. Yeah.
I'm telling you right now, I could listen to Stacey King make that call.
Yeah, it was.
I love big-time players make big-time plays.
They've got that zoom in on that Lakers fan who's just absolutely
heartbroken.
He can't believe it because
oh my God! Cry me a
point
ripper.
In 7 seconds. I know it was just unbelievable to see that because when they got the last one in, I thought that's got to be it, and to be able for him to chuck that in like that was incredible. So yeah, great start. Action-packed week as we went out. I mean, equities, as you said, Tom. It's interesting to see. I don't disagree with you. I think it would be great to see one last failed kind of push up here to lean into. We do have month end, which should be a little bit of a cushion, if not bounce, for equities. Now, granted, it'll play through FX and bonds and everything. Before we get into that, though, Victor, I've got a great rough rice copper cross trade I want to talk about. No, just kidding. I'm just going to push your time with that one. No, I think equities, it's really interesting to see the I honestly thought we would open 5-6 handles higher. Everybody who nibbled at an underwater close on Friday would then be put to the decision, and then we come back. We've been only open 13 minutes, so we still may do it, but they're not finding a lot of love at these lower levels here. So it'll be interesting. I think we have one more rally this week after month end as we roll into April. Pre whatever we have at the end of the week news wise. And I know we've got Knucklehead Day on Wednesday, but I don't think that means anything to anyone anymore in terms of tariffs. You look at the Euro tape action, some of the dollar tape, they're really, except for things like Canada, they're really starting to ignore all this tariff talk. I looked through it a little bit. Yen is some of the things I'm watching. The fact bonds put another point onto half a point tonight onto a 1 point rally yesterday is a lot. And there was never really any pullback in the bonds at all on Friday. Notes too. Long end getting the majority of the loving, not the short end. Japanese yen, same thing. Irrespective of what the dollar does, what equities does, bid going into yen. So those are a couple of things I'm watching, but I couldn't agree with you more. Some of these tech stocks, the equities markets are where you want to be right now. They're the ones giving you. We have, as much as Friday's, what were we down? 2.7% NASDAQ was a lot. You had two good rallies to sell during that week in either single names or the indexes if you chose to.
Speaking of tech stocks, real quick, let's go through a handful of these. Tesla was up something like 6%, a pretty decent amount last week until Friday. Obviously, they took some air out of the tires. Would you be selling that little rally up to 300 here? We're now at 263. What do you do? How are you thinking about Tesla? Directionally or just pure volatility?
I'm a pure vol trader in Tesla right now, so my position there is pure vol. But I do think that Tesla is a stock that you're going to get some. It's become a very political stock, so it's got a lot of, it's got a lot of baggage associated with it, so it's going to trade a little bit weird for some time to come. But I also think Tesla, this is more of a dead cat bounce than it is the start of something new. I think has real risk. I mean, if you think of Tesla as a car company, I think they have real risk. I have not seen since most of these companies where people get pissed off at them for whatever the reason is, like if it's a data breach, if it's a company that's has an airplane that's stuck on a runway, whatever the issues are with companies, people usually, time heals all wounds, and people tend to forgive.
This one.
Not this one. I agree. Yeah. Not this one. This is one where every single person that I know who has a Tesla is looking to get rid of it, and that means if whether they get rid of it or not, they're not buying another one.
Right.
And so this is not going to change, and Tesla's going to have a really big uphill battle to turn around their car company. Now, knowing Elon, he'll sell Tesla at some point to his AI company like he did with Twitter, and then next thing the AI, the Tesla shareholders will get out through an AI play. So I'm not sure how that works if you're an AI investor, but something like that's going to happen. That's his MO. He did that. Didn't he do that with the solar company too?
Yeah.
Not First Solar, but I forgot the solar company. Whatever. So he's got some tricks up his sleeve. But I just think that Tesla's is a damaged brand, and as much as Elon wants to go crying about people destroying Teslas or dealerships, that's not it. This is on him. He made a decision. It was a conscious decision, and he's suffering for it. But listen, Tesla's just one. A lot of these tech stocks. I mean, Netflix got annihilated, and Nvidia's down to levels.
Well, that's the second one. That's the second one, because anyone that stepped in at 105 was rewarded for the last 2 weeks, and now you're basically, to Pete's earlier point, being put back to the test at 109 with most of those people being underwater.
You didn't trade 105. I mean, I was trading Nvidia pretty actively when it got down, and to buy it in the 106 handle, you had to pick
the right half hour, right?
Yeah. You had to buy it pre-market, 8:30 in the morning. So it doesn't. I bought that stock in the high 105 handle, and I didn't even want to push the button. I
got 108. I got 108.
And I honestly, Vic, I think they're going to test the ranges here. So I think we do see a print sub 105. I wouldn't mind leaning long through that. I'm not a technician. Again, I'm not drawing lines on the chart. I know it would be a double bottom, but I think we're going to test the lows, the recent lows through there, but I wouldn't mind skewing something with premium on the longer side. If we do roll over to that point, we should get a little bit of bounce of vol, and that'll make it a little bit more interesting for me. But I would definitely not be playing just straight. I'm picking stuff because they're cheap. Because Tesla is the markdown from the election highs is incredible, but we're just back to that spot, really. I mean, we've just taken out unreasonableness and attached a really long tail kind of ugliness to that company that's going to be tough to beat up. This is a different animal for me.
But the other tech stocks, Vic, I mean, I think there's going to be a lot. Like I said, I bought some Google on the close. I'm going to regret it tomorrow morning. But I thought Google got down to a spot where 155, you're selling the 140 and 145 puts really juicy. I mean, there's going to be some out of the money put premium that. It's obviously not going to work if we continue to go lower, but there's going to be some juicy put premium on, tomorrow.
I don't disagree. Can I ask you real quick before you get out of here, Pete? Tom, since we're on the topic of NVIDIA, there was the CoreWeave IPO this week, which was, I think, by all measures, a bit of a disappointment. I think it opened at 39, closed at 40. They had initially priced this thing like 47 to 55. trying to raise $2.5 billion. They ended up raising $1.5 billion with a valuation close to where their last private round was. I think they ended with an $18 billion market cap, something like this. Pretty disappointing week to try to IPO. What does this IPO mean about AI, the investor appetite for AI, well, and just this environment for IPOs?
Let's throw CoreWeave. Let's give them a mulligan here. I don't know anything about CoreWeave, and I didn't trade the stock. There's no options yet. But let's just say that if it wasn't for bad timing, they wouldn't have any time at all. You know, I mean, when you come out on a day when the Nasdaq's down 3% and crashing, you know, you're not going to get a lot of love. I mean, you're going to get people to back off that want to buy it lower. So, I mean, all things considered, they reduced the size of the offering. It disappointed, but you know, they just, their timing was horrible. If the market was up 3%, the stock would have been 47. You know, I have seen moves like this in the past, and if this is the last spot, you're right, that I believe they raised capital at, and so there's going to be a lot of disappointed players, not only in CoreWeave, but in every single AI investment, including all the people that just invested in OpenAI at $200 billion. Mm-hmm. You know, I mean, this doesn't affect CoreWeave. This affects everybody up and down the line, every waiting IPO, everybody that's trying to raise money. I mean, like, this affects, you know, Elon Musk trying to raise money. This affects, you know, OpenAI trying to raise money. This affects everybody out there. And what it does is it puts a lot of pressure, you know, on the last capital raise, and it puts a lot of pressure on the IPOs, because these guys, you know, when you raise money at 18 billion, you're selling that this stock's going public at 35 billion. That's the only way you're going to get people to buy it, because they can't liquidate for 6 months. So they're touting this thing was going to be between 30 and 35 billion. That's the only reason people put money in. They don't give a crap about CoreWeave, you know. So if you want to buy CoreWeave here, it's probably on a downtick next week. It's probably got a little, like, you know, probably got a little Facebook in it. A little, you know, Uber went down right after it came out. PLTR, remember, it came out at 10, traded down to 9.
Snap got murdered for like a year before it came back.
Yeah. I mean, there's probably a very good risk reward in CoreWeave, except I don't know anything about this company, so I'm not saying, you know, I don't want to pass judgment or anything, but as a risk reward play, it's probably okay.
Pete, before we get you out of here, what are the areas of risk you really like for? You mentioned a few before. Are there any others you really like leaning either long, short, or short premium here?
Crude wrapped around $70, completely uninteresting. Nat gas around $4, same thing, not interesting. I mean, cheap stuff. You know, we talk about what's cheap. The grains are really marked down. Wheat's right near $5, close to $5 again. I think there's some more dollar weakness to come. So it will, again, some of the things. Euros pulled back a little bit from that. You know, we got with a brush of 110, we pulled back. I think we're going to see a little bit softer dollar continue to play through, irrespective of what announcement comes on Tuesday. They'll move off of that, but I think what we're seeing now is any move that's tariff related in the world of the dollar getting strong is immediately met with selling, and people people turning the other way. So commodity wise, you know, except for the metals, everything is looking a little bit defensive, a little bit less interesting. So I will keep an eye on gold, but I think gold has this proclivity. It's tempting. You know, we're up $125 in 30 days once we got through 3,000, but there's an elasticity to it that it's tough to lean on right here. It kind of wears you out. So we don't tend to spike to a new high and then come off $100. So I would be probably waiting a little bit of time or a little bit more juice into that market before I actually added short deltas.
I want to sell gold so bad tonight, Pete.
I'll buy it.
And what the problem
if you got physical bars, I'll buy it from you.
But there's nothing. Okay. Even if you wanted to buy yourself a little bit of time, Tom, there's nothing you can put it against. Like I sold gold last week, bought platinum against it.
No.
And for a day, it was like that was fantastic, and then the platinum just the big metal aspect of platinum came out. It was no good.
I can't
find anything good to put against it.
Vic, I wasn't sure if I was gonna sell, but when you just sounded so bullish to me that I just sold some futures.
I'm not bullish paper gold, but mind you, It's about physical for me, but
that's
another day.
You drew out the contrarian, Vic. Well done.
Yeah,
well done,
that
friend.
doesn't mean anything.
You just chubbed the water nicely.
All right, Pete. Appreciate it, my friend.
Have a good night, guys.
Yeah, you too. All right, Ilya Spivak, welcome. Welcome to First Call. Running anchor here. How you doing, Ilya?
Good. It's a beautiful weekend here in San Francisco. Stocks are down. Bonds are up. What could be better?
Bonds are up, I guess, 1.5 points, something like this from the lows from last week. I guess
I liked Friday's action a lot, though. That was very encouraging. I'd been accumulating at the long end as it was pulling back into kind of the sort of sub 116, and finally on Friday it seemed to really turn and mark a big outside move, as it were, a change of pace.
I think, this week, there's so much going on this week. If it was just a regular economic calendar, it's pretty packed with some decent events throughout the week. And now you throw in this April 2nd tariff announcement. I'm not sure how much juice is still left in that lemon. Let me start with you, Tom. April 2nd, how does Tom Sosnoff position risk around it into that date? What are you thinking about?
I'm not. I don't play those games. Homie don't play those games.
Homie don't play that.
I refuse to play those games.
So let me ask you this question. Do you expect any type of vol crush April 2nd? Are you expecting anything on the other end of this? Some sort of vol crush or fall to come in?
I know Trump does not like to capitulate, but he's not that strong, and he will capitulate, and he's going to be under pressure, not from other countries, not any of that stuff. He's going to be under pressure from his own party because he's starting to lose the constituents, and the backlash is going to be too great. People will hang with him until they start to, until they think their jobs are at risk. People spend a lot of money to become a senator or in the House of Representatives. They spend $100 million to get paid $150,000 a year, $180,000 a year. It's a very weird model because that job is worth, $50 million and everything else. So it's, people will look out for themselves eventually. And I think that's the risk he runs. He's not going to get any bipartisan support, that's for sure. And, so I think the pushback's going to be pretty heavy on him.
I've always, and Ilya, I'm going to ask you a very similar question in just a second, but just a quick follow-up to you, Tom. You've always told me the news is all bullshit. It's about price and whether price is expensive or whether it's cheap. Yeah. I'm curious, over the last week to 2 weeks, the media narrative is all of the volatility, all the price discounts you're seeing in equity. It's all around one narrative, which is all tariff. Do you buy into that, or do you just, again, there was a catalyst for an event, but in reality, stocks were expensive, and now we're in distribution mode? Where are you on this?
Actually, I don't buy into that narrative because, but I don't want to give away what I wrote about in the Cherry Bomb tonight. But I do give you a reason for what you're seeing, and it's not a reason anybody else has brought up. But I have my own theory on what's happening right now, and it goes from it's tariffs, it's consumer confidence, it's the economy. There's a variety of different things, but it's the same thing that is impacting them all. And I think that's the challenge that this administration is going to have to deal with. It's the perception of, but I don't want to get into it more. I mean, we do just trade price. I mean, we are, every single trade I make tomorrow is going to be not going to be based on what I think is going to happen with tariffs or anything like that. I think the reason I'm going to buy something, maybe it's Google in the morning, maybe it's NVIDIA. The reason I bought NASDAQ futures tonight and the reason I sold gold was because I think we're at various price extremes, and I think there's a lot of opportunity there. So I'm going to let the opportunity, talk for me, nothing else.
Well said. A man that runs his own content business says, I'm going to let volatility talk for me. That's a gangster statement. Ilya, going into the week, big calendar. Talk me through how you're thinking about either those events or any price extremes as you see them in play assets this week.
Well, I think first of all, Tom's right. The tariff announcement doesn't really matter because I think the markets have basically took on the idea at this point that no amount of market discipline is going to turn the administration. Or at least if there is an amount, then it's some amount that's much greater than this, because the sell-off that we've had near the lows of it, the administration was saying, we don't care, this is fine. And so I think the market has basically said, okay, fine. We're not going to look for the administration to say anything different. That's a dead end. We're instead going to look for the Fed to do what the Fed always does when fiscal policy is not to the market's liking and we start to create some sort of waves. We're going to look to the Fed to say, here comes the cheap money. Everybody relax. We're going to give you the thing that's going to help you to weather this. We're going to cushion you in cheap borrowing costs. And so I think that's the entire conversation now. Name an asset. Anything. Really, I mean, commodities, stocks, whatever. You look at it and it's all, can we get enough economic weakness to where it's not scary, but the Fed acts? And so I think that's the whole week this week. There's a bunch of stuff on the calendar. Obviously, we just heard from the Fed. They said, look, we see what the markets see. We commiserate. You're not crazy. You're seeing what you're seeing, but we need to see it in the hard data to act. This week, we have a bunch of hard data. Obviously, on Friday, the jobs report is kind of the poster child for hard data. So if the numbers are weak, we'll see how Powell talks about it, because, again, for a second consecutive month now, we get jobs data, and then a few hours later, Powell comes out to explain it. It's almost like another policy announcement. Like they've added more policy announcements to the calendar. So Powell can come out and go, right, so you've seen the number. Let me break this down for all of you.
Let me tell you what to think about it.
Yeah.
Yeah, but let's bring up one thing here I want to make this abundantly clear. This is not some kind of orchestrated sell-off in order to get,
of course not,
stocks lower, to get interest rates lower. That is not the play here. That is just things people are just saying, oh, that is that's the silver lining type thing. That is not the play here. So I'm not buying that at all. And the other thing is, we talked about this last week, which I think comes really into play. The reason that Powell did nothing last time, which is absolutely the smart move, and the reason the Fed is standing back and being quiet, is because they do hold all the cards when you get a market panic, if there ever was one. And so their job is to provide catastrophic insurance in case you need it. And so they're just sitting back, and that's their role right now. Just sit back, and hopefully you guys don't need us. But if you need us, we're here. And that's it.
Yeah. No, I think that's exactly right.
I agree with almost everything you said, Tom. I don't think this is an orchestrated stock sell-off to the extent that, like, of course not. Somebody's playing marionette or something like this.
No chance.
There's no liquidity pool like that can orchestrate something like this.
However, I think anybody, if you are trying to decrease the amount of government spending in an economy that is 1 out of every $3 of GDP, and you want to cut that down, anybody who doesn't understand what that is going to do, ceteris paribus, in the absence of anything else changing, it's very clear what would happen. So I think if you're putting forward a set of policies that will very clearly decrease the amount of government spending that's going into the economy, it has to be clear what's going to ultimately happen. Now, you might try to offset that with taxes, and then with easy money policy, you hope you can get through this period of volatility. I don't think it's an orchestrated sell-off, but I also don't think it's that far of a stretch to say you're going to cut government spending. What do you think is the logical result of that in the economy?
The thing with that is, you knew that this was coming at the absolute latest in early November, because it's not like you didn't know what the policy platform was going to be. You knew, markets knew, they had it fully priced in. After November, they very clearly did not panic, knowing that was the agenda that won out, knowing it was coming. They were clearly still very buoyant all the way into the beginning of December, where they kind of paused in what looked like, okay, let's see now it's about to get implemented. The markets really did not start to freak out about any of this until you started to see a collapse in business confidence and consumer confidence for several months in a row. So it starts in the January numbers. The markets go, but they don't freak out yet. But then it shows up in the February numbers and it's worse. For a second month, the markets go, okay, this is becoming a line now. It's not the nature of the policy that it's going to be a contractionary maybe on spending, but then expansionary on taxes, or that it's going to be tariffs, or that it's going to be this or that. Markets knew all these things. It's that they're now seeing how the implementation is hitting the real economy, and that's the freak out. If it wasn't hitting the real economy, if it was rolled out smooth, there'd be no issue.
And Vic, I don't want to get into a discussion of this tonight, but I fundamentally disagree with everything you just said.
How do you do that and then not follow up?
Because it's not the right place for it. We can have a discussion another time. It's the Sunday night show. We're talking about markets, but I completely disagree with that premise.
Noted, counselor.
I couldn't disagree more, actually. So just because you made the statement, everybody agrees. I could not disagree more.
Okay, fair enough. I'm very interested to know your response. I suppose I'll have to wait until Thursday.
That's why there's a two-sided market. I love two-sided markets.
All right, let's close this show super actionable. Let me go through a couple of assets. You've both given your opinions, but let's give a tight summary at the end of the show. Major market indices, Tom, it includes the SPOOs, the NASDAQ, and the Russell. How do you play them this week? Or any particular areas you like or dislike here? How do you play them, in your opinion?
Anytime you get a Friday afternoon underwater close and then a lower opening the next evening or morning, whatever it is, that tends to make me think that there is some kind of a short-term low either in place or about to be put into place. If I'm not exactly one of these people that remembers like all the old lows and things, but I think that 55, 60 something was the last time we got down here. This would be, to me, a very interesting kind of area early this week where it's probably a pretty decent risk reward if you want to take a little bit of a shot by selling some put premium, which I will do. So I think we're in for an incredible, we haven't made the lows tonight, but we're in for an incredibly volatile next couple of days. I don't think we're going that much lower to the downside. Let's put it this way. I would be surprised if we went sharply lower to the downside here. I think 5,500, maybe 5,550, which is only 40 handles lower in the S&Ps. I kind of like that area. I'm not a bull, but I think you're going to see high volatility. There's going to be a ton of churn up here. I think stocks are the only thing that matters. I don't think that anything else is. I mean, yeah, we sold a little gold tonight, but who cares? It's. I think gold's a good short, but that's the only commodity that's even interesting. Everything else is going to be a stock play. There's going to be plenty of premium there's going to be plenty of premium being bought. The market. I mean, I would accept the argument that it's teetering here, and it could have a little bit of a washout, but I just think it's more likely that this is a better spot to sell some premium and nibble, maybe a little bit on the long side, at least for the first half of the week.
Ilya, your thoughts on risk in the major indices this week?
I thought that Friday, the market really had to twist my arm to get short because, first of all, that was a massive move. Second of all, we're approaching the previous low, so that the risk reward's not great. But I had to do it because the momentum was so strong that this could be the beginning of a continuation. So if you look at the sell-off from late February into the March low, let's call that step one of a sell-off, then you get this shallow bounce, and then you wildly overturn it on Friday. If this is really momentum building, then it's going to be an elevator down, and you either participate or you don't, and you can't get too cute about it. So I had to put something on, but I don't like it. I think I'm in Tom's camp in the sense that I think the likelier thing is you get a little bit of a bounce as you begin the week, maybe only for one day on Monday, because the heavy risk starts on Tuesday. You start to get ISM, then you get more ISM, then you get a bunch of inflation data overseas. You work your way into NFP and then Powell. It's a action-packed week on the calendar, day in, day out. But Monday, you have a little bit of a window. So maybe you correct into 56 and change. And that's a place where you get another bite at the apple to sell. But at this point, this looks very bearish. Maybe not necessarily right in this spot. I'm not sure that I'd initiate a fresh short here. But at this point, either it breaks the prior low or it bounces and gives you a place to sell it. But either way, I think you get a short here that opens up one way or another, breakout or bounce, within 24 to 48 hours.
Yeah, I just think you watch NVIDIA, Microsoft. I think you watch the Mag 7s that are all sitting at support. And basically you say if NVIDIA and Microsoft hold, you probably got a decent spot to take overall market risk. But I think all this is probably going to hang in the balance of those stocks and the support on those 5, 6, 7 charts.
I did get short crude oil as a risk off bet. I think that's starting to roll over a little bit. I got long a euro again. I think that survived its pullback and seems to be attempting to rally back around. All of this, by the way, falls, stocks, currencies, commodities, all look like the same narrative to me here. And that's just, will the Fed bail out a growth scare?
I think the fact that we're talking about the Fed bailing out the market here at a 9% correction sounds insane to me. It's
a growth scare, a growth scare, not the market.
Victor.
What the hell are we talking about the Fed for?
Not the market. The economy.
I get it. We're down 9%, man.
I don't think that's the motivation for the Fed. I think it's the market saying the economic data is turning. The one piece of the world economy that cannot go down right now because Europe is anemic and China is anemic is the U.S. service sector. If you get that going down, you have a global recession that's inescapable. I don't think it has anything to do with the Fed going, oh no, the market's down 10%. Let's go bail out.
No, I'm not talking about the Fed. I'm talking about the market participants calling on the Fed at this point in time. I think it's so premature. It's crazy.
Bitcoin. They've called on the Fed for less. It's become kind of a Pavlovian response now.
And I'm speaking to the ridiculousness of that.
Oh yeah.
So
yeah.
Bitcoin's
I agree with you.
Tight range 80 to 90. This thing is supposed to be a highly correlated Nasdaq, but it's kind of hanging in a tight range. Tom, what say you on Bitcoin here? You're selling gold. Does that mean you're selling digital gold too?
No, I'm not selling any of my Bitcoin. No, I'm a buyer on dips. I don't really, you can't really trade it. So I buy dips. Yeah. That's it. And I buy, I just buy dips.
Okay, what about Coinbase, MicroStrategy? What about all the related equities? You say the story's all in equities. If there's nothing going on but buy the dip and dollar cost averaging a Bitcoin, what do you do with all the Bitcoin related equities here?
You sell as much premium as you can get your hands on. In Coinbase, you sell puts. In MicroStrategies, Coinbase and MicroStrategy are very different stocks. Coinbase is a real company. I don't know what MicroStrategies is. So I sell puts and calls in MicroStrategies, but I stay super small. In Coinbase, I skew it, sell bigger puts.
What do you make of GME taking a page out of MicroStrategies book?
Ryan Cohn's a complete moron, and that was the dumbest thing I've ever seen a CEO do. And he already got slammed for it. The stock's 10% lower already. It was actually
they diluted themselves though.
One of the dumbest moves. Well, they didn't raise any capital, but absolutely one of the stupidest things. If a CEO that I was invested in ever said that about my company, I would sell the stock tomorrow.
By the way, I think you're about to start seeing a lot more companies who are worried about the same thing you're betting on, which is a weaker dollar. I think states, companies, nation states are going to start looking for ways to protect themselves, especially if this thing gets going more towards the downside and more people, Ilya, start calling on the Fed to bail them out. I think people are going to look for a way to protect their purchasing power, and GME is going to be the second domino that MicroStrategy started, and you're going to see many more to come, my friend. So get ready to be pissed off at more CEOs, Tom. That's going to do it for us here.
On that note,
that's going to do it for us here on First Call, everybody. Do us a favor before you get out of here. Hit the like button, subscribe to the channel already. If you know somebody that would benefit from this content, do us a favor, share it in your social media feeds or send it via email. Make sure as many people as possible see this particular episode, and also know that no matter where you are in the world, we've got content for you starting at 1:30 a.m. Central Time. So all you degenerates that can't get any sleep, looking at your risk, or if you're in some other part of the world and it's the middle of the afternoon for you, join us here on Tasty Live. You can find us both on this YouTube channel as well as on tastylive.com. We will see you tomorrow bright and early only on Tasty Live. Until then, peace.